In today's volatile financial environment, the question on everyone's mind is, are we on the edge of a recession, or is the economy simply experiencing a mild slowdown? This uncertainty is gripping not only traditional financial markets, but also the cryptocurrency world, particularly Bitcoin, which has shown an interesting correlation to these economic dynamics. In this video, we're going to explore various indicators, both traditional and crypto-based, that could offer clues about what the near future holds. We'll dive into recession probability models, analyze labor market shifts, and review Bitcoin's performance against the backdrop of macroeconomic policy. Understanding these elements will give us insight into whether the markets are headed for a major downturn or if there's a softer landing in sight. Section 1. Evaluating recession indicators and labor market dynamics. One of the primary indicators to keep an eye on when discussing potential economic slowdowns is the smooth recession probability indicator. Although this is a lagging indicator and does not have predictive qualities, its current upward trend is something we can't ignore. As of July 2024, the indicator suggests there's only a 1.96% chance that the US economy was already in recession by then. While that might seem negligible, it's important to note that recessions are often declared retroactively, sometimes many months after they have begun. The fact that this metric is creeping higher could mean that we are at the start of a downturn, even if it's not yet fully evident in broader economic metrics. Moving from the smooth recession probability to more direct measures, the US labor market offers another crucial insight into the health of the economy. Over the past several months, we've seen a noticeable weakening in job openings relative to unemployed workers, indicating that the labor market is beginning to soften. Traditionally, a low unemployment rate signals a strong economy, and right now, the unemployment rate sits at 4.2%. At first glance, that might seem stable, and historically speaking, it's not a bad number. However, it's not the level that is concerning, it's the trend. A rising unemployment rate often indicates a weakening economy, and while we're not yet in panic mode, the data shows that the labor market is gradually losing momentum. This mirrors previous periods of economic uncertainty, where the unemployment rate first rose slowly before accelerating rapidly into what eventually became recognized as a recession. The real issue is not whether the unemployment rate is high or low right now, but rather the speed at which it is changing. Looking back at previous recessions, it's clear that when the year-over-year change in the unemployment rate becomes positive, the odds of a recession dramatically increase. Although we're not seeing a sharp spike just yet, the fact that it's rising gradually could suggest that we'll look back 6 or 12 months from now and realize we were in a recession the whole time. This is especially relevant when you consider the lagging nature of economic indicators like the unemployment rate. Section 2. Bitcoin's September blues and its historical patterns. Now let's shift our focus to Bitcoin, which has been experiencing a rough September. Historically, the months of August and September have been tough for Bitcoin, with average losses of around 6.4% in September alone. However, this year, Bitcoin has already dropped more than that, with an 8.44% decline so far. What's striking is that this year's performance is aligning closely with 2019, a year when Bitcoin saw significant declines in September as well. This raises the question, is Bitcoin destined for another deep downturn this month, or could we see a bounce? In 2019, Bitcoin's September losses reached around 14%, but that doesn't necessarily mean we're headed for the same magnitude of drop this time. It's important to consider both short-term volatility and long-term trends when making predictions. Bitcoin's recent decline is occurring as it tests key demand levels. Historically, these levels have acted as support, and there's a possibility that Bitcoin could bounce back, retracing some of its recent losses and moving back towards its 21-week exponential moving average, EMA. If it manages to stay above these demand zones, we might see a short-term recovery. However, the flip side of this scenario is that if Bitcoin breaks below these critical support levels, around $53,000, it could signal further downside. In that case, we could see a move down to the yearly open, which is in the low $40,000. The next few weeks are crucial for determining which direction Bitcoin will head. Investors should be cautious about being overly confident in either outcome. The market is often unpredictable, and it's essential to be prepared for both a potential bounce and a significant downside move. It's also important to note the psychological impact this market activity has on traders. In the past, many market participants have initially dismissed September's historical tendency to be a bearish month for Bitcoin, only to later panic when the losses start piling up. This type of emotional response can lead to poor decision-making, where traders sell after significant drops and then buy back in at higher prices once the market starts to recover. This kind of behavior often results in suboptimal trading outcomes, and it's why patience and strategy are essential when navigating these volatile periods. Section 3: Bitcoin dominance and the macro picture. One of the most significant trends to watch during periods of economic uncertainty is Bitcoin dominance. Bitcoin dominance measures Bitcoin's market share relative to other cryptocurrencies. Over the past several months, Bitcoin dominance has been trending upward, but it hasn't fully broken out into a durable uptrend just yet. This mirrors what we saw during previous cycles, where Bitcoin dominance didn't reverse course until after the first rate cuts from the Federal Reserve. Since the Fed has yet to cut rates and quantitative tightening, or QT, is still in effect, it's no surprise that Bitcoin dominance hasn't made a decisive move. However, based on historical trends, there's a strong likelihood that Bitcoin dominance will eventually rise once monetary policy starts to loosen. In previous cycles, Bitcoin dominance began to increase about a month after the first rate cut, and that trend continued until the Fed fully stopped QT. Given that we're not there yet, it's possible that we'll see Bitcoin dominance remain in this limbo phase for a while longer. What's also important to consider is that while Bitcoin dominance may be down slightly in recent weeks, the overall trend remains upward. Short-term fluctuations are normal, but the broader picture points to Bitcoin continuing to gain market share, especially as economic uncertainty deepens. Whether Bitcoin's price rises or falls in the short term, dominance is likely to keep trending higher until we see a major shift in monetary policy. Ethereum, the second largest cryptocurrency by market capitalization, has also been following some interesting historical patterns. In 2016 and 2019, Ethereum saw significant drops from its highs, around 70%, as it moved towards its logarithmic regression trendline. This pattern could repeat again in 2024, with Ethereum potentially dropping to around $1,200. This level would align with Ethereum's historical behavior and its long-term trend lines. Interestingly, Ethereum tends to follow Bitcoin's lead, especially during periods of market downturns. If Bitcoin continues to decline, Ethereum is likely to follow suit. However, just as with Bitcoin, there is always the possibility of a short-term bounce before a more substantial move lower. Investors should watch these key levels closely, as they could provide important clues about where the broader cryptocurrency market is headed. It's also worth noting that Ethereum's behavior during past cycles has often been a precursor to broader market moves. In both 2016 and 2019, Ethereum's price action hinted at larger trends that eventually played out across the entire cryptocurrency market. If history is any guide, we could see Ethereum's price movement once again act as a leading indicator for the next major market move. No discussion of the current market environment would be complete without considering the role of the Federal Reserve and its monetary policy decisions. Over the past year, the Fed has been raising interest rates in an effort to combat inflation. While this has helped to cool the economy, it has also put pressure on risk assets like Bitcoin and other cryptocurrencies. However, many analysts believe that the Fed will soon begin cutting rates as the economy slows down. Historically, Bitcoin has reacted strongly to changes in monetary policy. During periods of tightening, Bitcoin tends to struggle, as higher interest rates reduce liquidity in the market. However, when the Fed starts cutting rates, Bitcoin has historically rallied. This was most evident during the aftermath of the 2020 pandemic, when the Fed flooded the market with liquidity, and Bitcoin saw a massive bull run, rising over 1,500% in just a year. As we move into the latter part of 2024, the question is whether we'll see a similar scenario play out. If the Fed begins cutting rates and loosening monetary policy, it could provide the spark for another significant rally in Bitcoin and other risk assets. However, it's important to remember that this process could take time. Even once rate cuts begin, it may take several months for the effects to fully materialize in the markets. To sum up, the current market environment is filled with uncertainty, but there are several key indicators to watch as we move forward. The labor market is showing signs of weakness, with the unemployment rate trending upward, and the smooth recession probability indicator is rising, albeit from a low base. In the cryptocurrency market, Bitcoin has seen a rough September, but key support levels could provide a bounce. Meanwhile, Bitcoin dominance is likely to rise once the Fed starts cutting rates, and Ethereum could drop to around $1,200 based on historical patterns. Ultimately, whether we're headed for a recession or a softer landing remains unclear, but by watching these trends closely, we can gain valuable insight into what the future holds. Be sure to subscribe to stay up to date on these developments, and leave your thoughts in the comments. Do you think a recession is coming, or is the market set for a recovery?